Okay, in this video, I am going to go through the payback period. And the payback period is the amount of, essentially the amount of time that it takes to earn back our initial investment, right? So the payback period, are you fucking kidding me? Hold on. Come on. Let's see if we can do this the right way. There we go. Okay, the payback period. The initial investment divided by annual net cash flow, right? So if I invest $30,000 in a machine and the annual cash flow is expected to be about $10,000 every year, then my payback period would be 3 years. Alternatively, alternatively, we could have a second product or project, I should say, and that, hey, that's kind of cool. That project is going to cost us 40,000 initial investment, and that investment is going to yield 20,000 in cash flow every year. Our payback period would be 2 years for this second alternative. So what we're saying with the payback period is the shorter the amount of time that it takes to earn back our initial investment, the more attractive that investment is, right? So in that scenario, I think we would choose investment two, right? The payback period is only 2 years as opposed to 3 years. And the payback period is an interesting concept, right? So the benefits of the payback period are that we could be operating in very like rapidly changing environments, so like high tech. And if we have long payback periods, right? So if we're gonna spend a bunch of money, produce a new product, and the payback period is maybe 6 years, and it's a highly competitive, ever evolving industry, man, it may be the case that new products will be introduced within that 6 year time period, which would make our product much less attractive, and it would be harder for us to continue to compete in our market with that particular product. And therefore, a 6 year payback period is really unattractive in some industries. Okay. So the more competitive and the more that things change, the shorter we want the payback period. The disadvantages with the payback period could be that, yeah, I agree that this second option has got a 2 year payback period, but what if the life of the project was only 2 years and the life of this particular opportunity was 6 years, right? So under this alternative, we would earn 10,000 in cash in years 4, 5, and 6. So we would recoup our investment and then we would earn an additional $30,000. In this investment, if the useful life was only 2 years, then we're not going to earn anything year after year, right? So this investment with the 3 additional years of cash flow actually look a little bit more interesting because there is profit to be had with that particular approach. So the drawback to the payback period is that it doesn't necessarily account for the remaining useful life and how much overall profit we're going to make. Okay. So there are some limitations to this approach. We could go into a slightly more sophisticated analysis. It's the same concept. Again, it's still the initial investment divided by annual net cash flow. In this particular example, we're saying that the initial investment is $16,000, right? So that's the numerator. The useful life is 8 years. There's going to be no salvage value at the end of that 8 years. We're going to sell 1,000 units And then my ugly mug is in the way, so I'm gonna move it over here. Okay. The selling price is gonna be $30 per unit. Then we're gonna incur 16,500 in materials, labor, and variable overhead. Here's an interesting concept. This is what I would really pay attention to. Depreciation. Okay. The formula calls for net cash flow, not accounting profit. So depreciation is an expense, but it is a non-cash expense. So when we are using the payback period, we really want to make sure that we're focused on cash flow. Okay. We are looking at cash flow and not net income or net profit. So we're not going to include depreciation. Selling, general and administrative expenses, we're assuming that's all cash. Okay. So 30,000 in sales, 16,500 in materials, labor. We are not including this in our calculation. 9,500. Our net income is 2,000. However, since we're not including depreciation, our cash flow is 4,000, right? So 16,000 initial investment divided by an average of 4,000 in cash flow every year. Our payback period is 4 years, right? And then we said the useful life was 8. So we're going to continue to earn cash flow of 4,000 in years 5, 6, 7, and 8. Okay. But that's something that we don't account for in this particular approach. Now, in the real world, it's rarely the case where you have the same cash flow every year. Cash flow is always going to fluctuate year to year. Okay. So we can deal with that in a slightly different way. We just have to change the formula ever so slightly. Okay. So in this particular example, we want to install a machine. The initial investment is going to cost 16,000. It has a useful life of 8 years, no salvage value at the end. And then the annual cash flow, okay, the annual cash flow is going to be 2,000 in year 1 and then 4,000 every year thereafter. Okay. So again, since that's not an equal number every year, we have to use a different formula. And to me, what I like is this is slightly confusing in my opinion. What I prefer is I like to say, hey, you know what? I've got to earn 16,000. And so what I'm going to do is I'm going to do a cumulative total. At the end of year 1, I have 2,000 that I've earned. In the second year, I'm going to earn 4,000. So the cumulative total is 6,000 at the end of year 2. At the end of year 3, I'm going to earn another 4,000 in cash. So the cumulative total is still not 16,000. It's 10,000. Year 4, I'm going to earn another 4,000. So total is going to be 16,000. And then in year 5, so I'm still not there. Actually, sorry, I'm doing my math wrong. I'm at 14,000. So I'm still not there. In year 5, I'm going to earn another. So I earn 18,000. So now I'm knowing that somewhere between years 4 and 5, I'm going to earn back. So seriously fucking sloppy, right? So somewhere between years 4 and 5, I'm earning my payback period. So my formula that I like is I like to do the number of full years. Okay. The number of full years plus in that last year, how much I have left divided by that year's cash flow. Okay. So in our example, right, year 1 is a full year, year 2 is a full year, year 3 is a full year, Year 4 is a full year, right? Because I've only gotten to 14,000. So the number of full years, 4,000. Sorry, 4. Then what do I have left? Well, at the end of year 4, I had 14,000 and I've got to get to 16,000. So in this 5th year, I really need to earn another 2,000. And in the 5th year, my cash flow in that particular year is 4,000. And therefore, it is 1/2 of a year. So in total, I'm at 4.5 years, right? The book does it slightly different. They say, okay, listen, the initial outlay of cash is 16,000. Then in the first year, we're going to earn 2,000. So I'm going to reduce the negative by 2,000. Then in year 2, we're going to earn another 4,000. So I'm going to reduce the negative from 14,000 to 10,000. In year 3, we're going to earn another 4,000. So I'm going to reduce the negative by another 4,000, etc., etc. Then they get year 4, right? They have 2,000 left. They're going to earn 4,000. And so they're going to have a positive cash flow in that 5th year of $2,000. But they still don't really do a good job of explaining that, which is why I like mine better, right? This is how you get the half. Okay, payback period. It uses cash flow. That's something that we definitely want to keep in mind. And it's definitely easy to compute. And then, like we were saying, it ignores the cash flow that we're going to make after the year that we break even. And it also ignores the time value of money, which we're going to get into in a separate video.